Morningstar found that the single biggest predictor of a fund's performance is how low the fees are. So what happens if you're invested in a company that makes money on high fees? Asset managers like Rowe and Franklin Templeton are under a lot of pressure while BlackRock is thriving. What gives? If you're invested in any asset manager, you'll want to watch this presentation. Let's start with the basics. When I was a hiring manager, one of my favorite questions to ask people in an interview just to get an idea if they had a good understanding of industry was this simple question: what's the difference between passive and active management? It's very simply this. So an active manager tries to beat a benchmark like the S&P 500. A passive manager simply gives you the performance of the S&P 500 minus fees. There's also a tracking error associated with that. And at my previous job, we built software that helped portfolio managers track their tracking error. So if you're a portfolio manager and you're doing active management, that takes a lot more work than doing passive management. So they say here, this is from Investopedia, a reasonable expense ratio for an actively managed portfolio is about 0.5%, or let's say 50 basis points to 75 basis points. For passive funds, the average expense ratio is about 12 basis points. So this is a very important question here. When 95% of active fund managers can't beat their benchmark in the long term, what are you paying for exactly? And I think that investors have been asking this question more and more lately because here, this piece from Accounting and Business said 2023 was a watershed with total passive funds by value exceeding active funds for the first time ever. And when you look at a product like the Vanguard Total Stock Market ETF, you get exposure here to the United States for 3 whopping basis points. That's unbelievable. So Vanguard's known for low-cost products, and when we look at ETFs, these are exchange-traded funds. They're based on an underlying index, and they're typically passively managed. As I said, you have to match the benchmark performance. It should largely be automated these days, but not all ETFs are passively managed. You could think of ARK Invest's ETFs. Those are active. Most of them are. Here you can see on this chart, this is just incredible. The industry average 54 basis points for a fund, and Vanguard's average 9 basis points, declining over time. Both are, and that's going to be talked about more today. I like this piece by Thornburg. It says, active management is dead, long live active management. The idea being that if it's a good year for passive investing, articles cheer indexing and report the death of active management. So you, of course, need to pay attention to trends, but I like this slide from BlackRock. There's 2 points I wanted to make here. So BlackRock is the largest asset manager out there, and they simply break down their assets under management, that's what AUM stands for, into different buckets here. Let's start with the first client type. Look how telling this is. So 54% institutional for AUM, but only 31% fees. And then 9% of their AUM is retail, but that accounts for 27% of the fees. So retail's more willing to stomach higher fees, as we've seen talked about before. Style here, this is also interesting. So look at active, that would, remember we talked about active management. Active management for BlackRock makes up 43% of fees, but just 25% of AUM, whilst indexing, which usually collects a very small percentage points on whoever you're licensing the index to. It's 31% of AUM, whilst accounting for just 8% of fees. So when we look at asset managers, and this list here is from 2022, but it was the most comprehensive that I could find. Some lists exclude certain asset managers. I don't know why, but here you can see the ones that we're mainly concerned with: Franklin Templeton and T. Rowe Price in 14th and 16th position. And these firms are dividend champions. That's why they fall on our radar. When we look at BlackRock, they're not a champion yet. So they had their track record going there, and they broke it in the 2008-2009 financial crisis. They should have just increased that dividend by a penny to keep that track record, but they didn't. And now they have 15 years of increases, so 10 years until they're a champion, and they'll come on our radar at 20 as an upcoming champion. But this piece here was rather alarming when I read it. It talks about, of course, we know that money's moving from active fund managers to passive fund managers. But look here at the third point. Money is pouring out of T. Rowe Price and Franklin Templeton, known for their actively managed mutual funds. Well, that made me immediately wonder just how much active management is happening at both of these companies. So when we look at T. Rowe Price, this is very telling. So take a look at the net flows. That's the first line in this table. Net flows would be for any asset manager. They have money coming into their products, people saying, all right, I'm going to put money into your products, and money going out, people pulling money out. So the net of that, you would like to see increasing over time. Well, it's not. You could see here that for Q1 2024, they had $8 billion outflows, and Q2 2024, 3.7. But look at their assets under management. This is interesting and a very good point to make. Assets under management increased over that time frame whilst net flows decreased. How is that possible? Well, this chart shows you. So this is their assets under management over time. You want that going up because you're getting fees from that. Look at the market change. So when the market's going up, the assets under management increases, right? That makes sense. So in bull markets, these firms are doing better than they do in bear markets. Now look at net flows along the bottom. So even though the markets are going up and their assets under management are increasing, investors are pulling out money to offset that. So one point that T. Rowe wanted to make in their recent presentation was that their net outflows were $24 billion less in the first half of this year than they were in the first half of 2023. So they're talking specifically about how they're trying to curtail those outflows. But when you look at BlackRock, look at this is incredible. Look at their net inflows. They're not suffering at all. Why? Because BlackRock's pulling in a lot of that passive money. And their track record here, you can see 3.8 trillion to 9.1. It's actually, I think, around 11 trillion now. They're doing a great job. And see their market FX movements, the chart below that shows you how the market is affecting their AUM as well. But overall, the net effect of that is that they're increasing AUM significantly over time. So when I tried to ask Perplexity about the amount of active money managed at T. Rowe Price, they said primarily focused on active management. I couldn't find the answer. Perplexity couldn't either. They're estimating somewhere around 38% of the firm's total assets under management. I don't know about that. It would seem higher just based on their, 40 or so basis points on average that they charge. But it's difficult to say. But in the latest T. Rowe earnings call, we see a movement towards passive. So here you can see these bullet points. They say, well, market gains continue to support our financial results. We're making steady progress in flows and investment performance. So they say, we continue to be on track to substantially reduce net outflows this year. Great. That's what we want to see. And then they talk here about their ETFs. They have $5.3 billion in assets under management for ETFs, up significantly by $1.2 billion. They say in the first half of this year, we've had $2.4 billion of inflows to our ETFs. They say, well, that's really small considering they're a $1.4 trillion asset manager. So they're a little late to the game. And of course, this is going to be one of their answers to trying to reduce all those outflows. Now, this chart here is rather interesting from T. Rowe. It shows their assets under management broken down by institutional and retail, and you see the net flows there along the bottom. So you see that for Q2 2024, they had a positive institutional flows and a negative retail there. The net of both of those would be, of course, outflows. But they talk about how retirement assets are 67% of their assets under management. I thought that was pretty interesting. It's easy to pack retirement options with high fees. We see this all the time. People who have a retirement account at their place of employment and just sock money into it and don't really pay attention to the fees. HR certainly isn't going to step up and help you spend less. So what's the impetus for change for this money that is being run for retirement accounts? I don't know. But the takeaway so far is this: active management is falling out of favor. Low-cost providers are put under constant pressure on their fees. It's hard to believe retail knows or even cares about fees, but we're certainly trying our best to educate them. Stemming outflows is going to be the most important task for asset managers that have a consistent track record of net outflows like T. Rowe and Franklin Templeton. Speak of the devil. Franklin Templeton's reduced dividend growth over time is now very understandable, and even more so When you look at this, is their monthly assets under management report. They started reporting on outflows for Western Asset Management. And we've talked about this before, the problems Ben's running into, some compliance issues. The SEC's investigating. Overall, it's not very good, but investors will get spooked and pull their money. So September, you see, $7.7 billion of long-term outflows at Western Asset Management. But then look at what this is just less than 2 weeks ago. Their month-end assets under management. Look at this at the top there. It says nearly $28 billion of outflows at Western Management, and that brings the quarterly outflows to around $31 billion. So we've just charted these over time, and there you can see this last quarter, the $31 billion there and the quarterly flows. And then if we aggregate that all together, since we have 4 years of data, you could see there's been a consistent problem with outflows. But what I found interesting is that T. Rowe actually has worse outflows. And when you look at the assets under management for both these firms, they're sort of neck and neck. So I think comparing them, it's apples to apples pretty much. So T. Rowe's actually had a lot more outflows. I thought that was interesting. But this article by the Wall Street Journal shows one of the ways that Franklin Templeton wants to fix the problem. It says they turn towards private investing as mutual fund business shrinks. And their current CEO, I thought this was interesting, taking over from her brother, who became executive chairman. It's never good, I think, to have, family. I think her grandfather was founded the company or something like that. Are these really the best possible people that you can get for that job? I don't know what the answer to that is, but I just thought that was worth noting. During her time as CEO, Ms. Johnson oversaw, she's been CEO for 4 years now, a series of acquisitions. Legg Mason, that's what brought Franklin Templeton on par with T. Rowe in terms of their assets under management. Then Lexington and Putnam actually has a little bit of a shady past there. So I don't know if they're acquiring more problems, but trying to grow the business through acquisitions, I suppose, is one strategy. But that there's a lot of pressure right now in industry for lower fees. And when we look at T. Rowe against Franklin Templeton, so this here is our Q-score calculator. It's going to be made available, if it's not already, for premium subscribers, and it allows you to navigate over 200 dividend champions and upcoming champions. And here we've filtered on financials. I'm just showing you the top 5 there. And I think the first takeaway here, if you look for T. Rowe Price, see how their dividend growth is accelerating. So at 9.6% 10-year, 16% 5-year. That's good. Look how Franklin Templeton is decelerating, 14% 10-year, 7% 5-year. So Ben, of course, has encountered some compliance issues in a subsidiary, and this is likely to pass, but we're more concerned with their slowing dividend growth. The other asset management champion is T. Rowe, and that made us ask the question, what does the future of asset management look like? And that's this presentation. The higher yields are very appealing for dividend growth investors, but are they sustainable? So just some concerns. Active investing is understandably losing momentum to passive, and that's a problem for firms that pay the bills with a lot of actively managed products. Retirement accounts might prove somewhat durable, but I think trying to get into the ETF game this late is tough. You're competing against BlackRock and Vanguard. BEN, Franklin Templeton, is fighting multiple problems. Overall decline in active leading to outflows, large outflows for Western Asset Management, no closure for that current tussle with the SEC. We need to see closure for that. And poor investor relations in general. I found it very difficult to navigate through their information as compared to T. Rowe and BlackRock at the top of the pack in terms of their ability to effectively communicate messages to investors. So here's our thought process. For Franklin Templeton, we exit champions for one reason only. That's if dividend growth stalls. It hasn't. But the bigger question here is, do we remove it from our new money report? So this is one of 10 dividend growth stocks that we find most compelling. Can we say that today? I don't think so. So likely, yes, we will be substituting that from the new money report. We make decisions like that very slowly and methodically. So the question is, would we replace it with the closest substitute? That would be T. Rowe. Well, T. Rowe's facing the same headwinds. What's the best case scenario for T. Rowe? Well, it's that they're able to continue stemming outflows, which they are showing progress doing. But when we take a more holistic look at our options, I don't think Aflac would make the cut. We did a piece recently on them. They have a lot of dependency on Japan. Sure, the stock is doing great. Everything's rosy, but I think that's a bit of a quirky one there. S&P Global is of interest. That's been added to our research queue. We're going to cover that next, so make sure you subscribe to our channel. And I'm going to go ahead and leave you with a recent piece we did on Franklin Templeton, which goes more into detail about the problems they're having with Western asset management. Thanks so much for taking the time to watch this today.